It's time to welcome in Milton Ezrati, Chief Economist at Vested. Good morning, Milton. Appreciate you joining us.
It's a pleasure to be here.
So we're continuing the conversation that we were just talking about with Ben, our previous guest, about some of these mixed signals that we're seeing about the economy. We talked about the yield curve inversion. We talked about the Fed saying one thing, but economists forecasting another. But we also have, of course, inflation at 40-year highs, a strong labor market, and consumer confidence that's waning, especially about future expectations. So where do you stand in all of this? Do you think there are more economic headwinds or tailwinds at this point?
I think the tailwinds are fading and the headwinds are growing. That's not a very optimistic view, but that's the way I see it, where we've had a very strong recovery from the lockdowns. That's pretty typical of any economy that's had an artificial constraint. You remove the constraint, and we have largely removed it, and you get a spring back. But that's slowing, and when we've caught up, I reckon in the second half of this year, at the latest, then we're going to slow down to trend growth, which is going to look very disappointing compared with the numbers we've seen in the past year, especially for employment. And then we have the inflation and what the Fed is doing to cope with inflation, both of which are headwinds for this economy.
So the headwinds are growing. What's the biggest obstacle we're facing in terms of the economic recovery right now?
Right now, I think it's the inflation itself. Inflation has a very distorting effect on the economy. And so it will work recessionary forces all on its own, even if the Fed would pretend that it wasn't happening, which it did most of last year. Even if the Fed were to pretend, so that could build. It would take a while before it had its recessionary effect. We'd have a stagflation, and then we'd have a recession. But if the Fed is true to its word, and it's talking tough, it's not doing tough, but it's talking tough. If it's true to its word, we're going to have rates move up very smartly over the next few months, and that itself could create a recession. The Fed has tried many times in the past to generate a soft landing, and usually, not always, but usually fails.
So in terms of inflation, though, the Fed is no longer ignoring it. It's no longer in the transitory camp. We know that. But it's not also just a matter of suppressing demand, because we're in an environment with supply chain issues and commodity shortages that are likely to continue for a while. So are you confident that the Fed can even tame inflation with rate hikes in this environment?
Well, it certainly complicates the Fed's job. I think that as the economy slows, and we've already seen some of this slowing, we got some very good employment numbers a couple of weeks ago, well, not even 2 weeks ago, when the Labor Department released its March review. We got some very good numbers, but they were far slower than we'd had been seeing. So we're already seeing a slowdown. That slowdown itself will alleviate some of these supply chain problems. And so that will make some of the Fed's job easier, but it's not necessarily a good sign for the economy. So yes, it complicates the Fed's job, and I don't envy Jay Powell, but the Fed has only one direction it can go for the sake of the economy, and that is raising rates, restraining credit, and slowing the economy.
I heard you say the Fed usually fails with the soft landing. So I know you said stagflation comes before recession, but ultimately a slowdown. Are you in the recession camp at this point? Do you think the Fed will slow the economy enough to push us into a recession?
I think ultimately the Fed's going to be forced to do that. Consider the path they have to go on. We have inflation rates now in the United States of 7 to 8%, depending on how you measure them. Right now, Fed funds are at 0.5%. In order to really have a constraining effect, the Fed has to raise rates at least to the rate of inflation, if not higher. That's a long way from now, and that's a lot of pressure. We've only seen a 0.25 percentage point increase, and people are saying the Fed's being restrictive. They're not. They will be restrictive if they're going to beat this inflation, and I think they're going to do it. That's going to have a tremendous restraint. I would say, given the way the Fed's moving and how long historically it takes for inflation to have its recessionary effects, I would say we have 18, 24 months before we start seeing the real negative news.
So 18 to 24 months is pretty far out. But I think also, should we be looking at this a little bit differently? Obviously, we in the media can also be guilty of this, but we treat recession as this big bad word. But should we be looking at it as just a normal part of a healthy economic cycle to just right-size things, or no?
Well, it is a normal part of the cycle. It's not healthy for the people who get laid off during the recession, certainly, but it is a normal part of the deal. I wouldn't call it an ugly beast. It's certainly less pleasant than a boom, but I wouldn't call it an ugly beast. The economy needs adjustments from time to time. There are always excesses. This inflation happens to be a sign of a huge excess that's been going on for quite a while. I know the White House would like to blame it on supply chains. The White House would like to blame it on Putin, but it's really because we have been very free with money creation since 2009. So we have a fundamental adjustment here, and it's going to have to be worked out. And unfortunately, a recession is going to be a part of that, one way or another.
But not for 18 to 24 months. And we have a very tight labor market, and we have a very strong consumer. Yes, confidence is waning, but we're not necessarily seeing that in the here and now in terms of how they're spending and what they're spending on. There's still a lot of pent-up demand. So at what point do you think we see that start to hit consumer demand?
Well, I think the ISM report we got just a couple of 3 days ago, a little more than that. The ISM report we got said that even though prices are rising, consumers and buyers are still enthusiastic. So we have seen some abatement in the pace of hiring. We have seen some abatement in consumer confidence. They are aware of the dangers of inflation, even if it's only an intuitive understanding, not an explicit understanding. So their confidence is down, but it takes time for these things to have effect. Even the Fed raising rates, and that's why I'm saying an 18 to 24 month horizon, barring another shock. I think that's reasonable. That's a long time if you're a day trader, or even if you're thinking quarter to quarter. My point of view, or I'm trying to look at the sweep of the whole economy, it seems like tomorrow, but everyone has different perspectives.
So what specifically are you keeping an eye on? We were talking about some of those signals, obviously the yield curve inversion. Also, we talked about this week the Dow transports being lower, which could be a leading indicator and point to a recession. But what specifically are you looking at to know, okay, a recession's coming?
Well, I think there are two steps here. One is when we start seeing more historically normal higher rates of hiring, more historically normal rates of growth in areas like consumer spending. We've seen some hesitation in housing. My God, mortgage rates have almost doubled from last summer. So that's understandable. But when we start seeing signs like this, it's an array of statistics that show either slower growth than we've grown accustomed to. That would be saying the catch-up is done and the economy is moving back to trend. And then ultimately we see some signs that people are pulling back. Well, one of the best indicators is the ISM. They give us not only statistics on where the firms are doing well or expanding. We've seen the orders numbers shrink back down. That's a sign that the economy is slowing. And they also give comments, and the comments that they give are particularly interesting. The one that I say would make the recession a longer-term prospect or a more distant prospect is that business said people continue to buy despite the rise in prices. If they start saying they're seeing hesitation among consumers, that would be an early warning signal. We get this review the first few days of every month. It's, I think, a very important indicator.
And we'll also be getting some earnings starting next week that should give us a better sense of how companies are able to pass those prices on and if they're getting any pushback from the consumer. We have to leave it there, but Milton Ezrati, chief economist at Vested, really appreciate you breaking it all down for us. Thank you so much.
Thanks for having me on.